InCred AMC. He's joining us right now to take some questions. Mrinal, good to have you with us here. Thanks very much for your time. Prashant this side. How are you looking at things, Mrinal? If you have time on your side, would you consider this a good opportunity to buy high quality names? And what, in your opinion, has pulled back enough where there is now margin of safety?
So, and thanks for getting me over to the show. See, every sharp drawdown in the market is a very interesting time to pick up investments. So yesterday was another one. And what remains a fact is that the outlook for Indian economy is obviously quite robust, particularly in segments that are driven by the capacity expansion side. And we would keenly observe and pick up potential investments in that space, and that is what we are kind of doing. The market turbulence is something that offers us interesting prices from a long-term perspective. As you said, longer horizon investors would obviously be keen to make the most of it, and we are no different from that perspective.
Okay, Mrinal, good afternoon. Two spaces where we have seen some decent correction and actually brutal correction in some names. One is midcap IT and one is some of these platform stocks. Your thoughts on these?
So our assessment towards the future growth outlook and risk reward proposition is more inclined towards domestic manufacturing and capacity addition led businesses. Sectors that are going to meaningfully participate into something which as of now looks like China plus one, but there could be addition to that in the areas of textiles, in the areas of chemicals, engineering goods, even automobiles. They are more aligned to the greener future of economy, and even housing and mortgage seems a very interesting place. So we would be more inclined towards that, which is where we find valuations more appealing, and which is where our inclination remains.
Mrinal, I wanted to ask you about textiles. That's the boring sector that suddenly come to life, and the last quarter's numbers look very, very good. But I was doing a couple of ground checks, and it appears those spreads, on spinners at least, are going to get squeezed. So how do you play this space, and do you believe it has a long runway ahead? Could it do something like what specialty chemicals did, say, in the last 18 months? Go ahead.
Yeah, so interesting observation, Nikhil, and I think the volume play on these businesses could look very different in a couple of years. We are already seeing a lot of these companies kind of putting orders for their expanding their capacity on the spinning side in particular. And if you look at the merchandise export numbers, amongst the most consistent growth numbers have kind of come from the yarn and the textile guys, in 20% vicinity back to back for quite a few months and quarters now. So yes, we've seen some bit of pressure on the margins, but normal, I would say. I would not be worried about it. In general, corporate India post the corona phase had aggressively cut costs. So the margins were trending a couple of percentage points ahead of the long-term trend, which has gotten corrected a bit. There has been a raw material cost pressure, but then the volumes is where I think there could be a very big surprise the market could see going ahead in the case of textiles, and more so even on other sectors. I would compare it with specialty chemicals. Specialty chemicals, the drivers were different, but is the opportunity side something similar or as big? The answer is yes.
Mrinal, two specific areas, if you have any thoughts. One is real estate stocks, and what do you think now? Because they've also, a lot of them have pulled back quite a bit. And the other is this entire commodities complex. What's your sense there? I mean, in India, on the listed front, we don't have lots of pure play names, sort of direct plays on what underlying commodity prices do, but we have a few. Your thoughts on both these spaces?
So very interesting space. I think housing, residential housing volumes, very, very good outlook, I would say. But then direct real estate companies, we are very picky and choosy about it. We find it quite complex. We find it much more reasonable and understandable to play those volumes through something like a mortgage. Mortgage has become consolidated after the 2017-18 shake-up in the market, and we also think that there are building materials which can be a good way to participate into that volume growth trajectory. There are the likes of wires and cables. There are the likes of sanitary, tiles, cement. If we see the government capex number panning out on the ground, along with the housing revival, I think there will be very strong demand for cement as well, particularly in the region. Particularly regions where there is more activity. So there are those drivers in the value chain where I think housing would be a very interesting segment as such. It is by far the largest employer in the nation, so it has always found favors with the policymakers in India. Now to commodity complex, yeah, that is cyclical that we need to keep a track. But then housing clearly has more favor. So I don't have a strong view on commodities as of now. It is largely a function of how every base metal more or less has a 50% capacity in China. So it's largely a function of how the Chinese scheme of things on growth pan out. But then on the housing side in particular, domestic drivers, domestic commodities that feed into it, and overall dynamics are much more understandable and control, and we favor that far more than commodities.
Okay, fair point. Now, Mrinal, we had news earlier that the central government has asked states to sort of get back to normal now, and some of the states are already getting back to almost zero restrictions. So this opening up trade, hotels, restaurants, all these cinema halls and all, a lot of them have already gained back quite a bit. But do you think there's more left here?
I would say, that's one, people call it COVID recovery. I think that's a legitimate thing to expect. Along with that, the transition of per capita income that we are going to see in the next 3 odd years, from $2,000 odd to $3,000. It is a well-established trend that globally any economy that has gone through it, the households typically tend to invest incremental monies towards education, travel, entertainment, leisure, consumer durables, housing, and things like those. So, they an healthier way of life. So it also dovetails, these things dovetail, into that idea and that trend as well. So we might feel that, okay, opening up of things clearly would benefit, things like a cinema or in a mall and those things. But then I think that has a long way to go. We will see. What has also happened is, even if demand recovers in terms of volume to the same level, in case of hotels, in case of airlines, in case of entertainment options, there has been some consolidation in the supplier space, which is the likes of malls, the likes of other options. So the consolidators are clearly better positioned both in terms of capturing higher volumes and pricing. So, well, the trend, when things do normalize, and it looks like our domestic growth could be on a good track, be it the Moody's, which has talked about 9.5%,
correct,
or even IMF, which says 9, RBI says 8.5. I think even if you take the lowest of those numbers, we could be in for very positive volume numbers for all these guys.
Very quickly, you spoke about metals briefly. Preference towards ferrous or non-ferrous?
I would say non-ferrous is very interesting. It's looks better than ferrous, but nevertheless.
It's been a good chat, Mrinal. Thanks so much for stopping by. Wishing you a good evening and a good weekend ahead as well. Looking forward to chatting up with you rather soon. Well, let's address some news that's coming in as tensions between